Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Also, I'll just let you have a look at the disclaimers that I need to show you. I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal really is to break down all the market jargon and complexities that we all read about. So if you do have any questions, please do ask them along the way, and I'll try and help and answer them, of course. If you look at any setups that you want us to look over, or just simply any basic questions, whatever they are, please do ask them away. As I say, I'll try and get to them during the webinar, or at least after the webinar finishes. Also, I'll just let you have a look at the disclaimers. I just double check a couple of things to make sure you can see what I'm seeing. Okay, it's just after 11 o'clock in London, UK time, that is. So let's get to it then. Markets currently, well, first of all, yeah, we'll check out how markets are shaping up this week. Middle of the week, a very busy week, data heavy, central bank meetings, of course, and then non-farm payrolls on Friday. Yeah, we'll just check out how markets are shaping up currently. We'll look at gold as well, because obviously that's been grabbing headlines as it shines, making record highs. We'll then look at US equities and this idea about a potential bubble taking place at the moment, although we have obviously seen a slight sell-off in the first couple of days of this week. We'll briefly touch upon the inflation data out of Japan, the US, and the Eurozone last week, before then getting into this week's key big risk events. So a couple of central bank meetings, that is the Bank of Canada out in a couple of hours. The ECB meeting as well out on Thursday. We also have the UK budget very soon, which could be of interest, slight interest really, just longer term impact more so, possible small impact on sterling, I guess. And then we'll wrap it up with a look at the non-farm payroll report, the US monthly jobs report, that is, of course, as well as touch upon what we are expecting out of Fed Chair Powell's semi-annual testimony in front of Congress later on today. Of course, we'll look at all of those events plus their related currencies, so dollar CAD, euro dollar, sterling against the dollar cable, the DXY index, and we'll kick off, of course, as I said, with stocks and how markets are shaping up currently. Yesterday, interestingly enough, big tech weighed on broader US equity indices, really. Nvidia actually the only gainer among the Magnificent Seven stocks. Those all slid between 0.5% and 3.9%. Interesting, really. We touched upon it a couple of weeks ago, actually, just about this difference that we're now getting between some of these Magnificent Seven stocks. At least 3 of them, I think possibly 4 now, are showing year-to-date losses. Apple down 9% on the year, for example. Tesla much more, and we only have sort of a few stocks now in that Magnificent Seven which are up on the year. So really, sort of divergence really between those stocks, and whether that Magnificent Seven really is now a sort of Magnificent Three, I think, is potentially something to look at, and kind of a bit of a lazy moniker in a way now, although obviously they had they caused big gains in the major indices with their big weighting, obviously over the last few months and 18 months or so. Aside from that, then, We had China's NPC announcements, which was slightly underwhelming, though they did help Asian stocks today, really. Investors looking to see what concrete measures will come from the Chinese authorities. 5% GDP target, of course, is quite bold. Some would say 3.5% fiscal deficit, I think, or budget deficit even. And that, again, interesting play, certainly for the GDP growth number, 5%. They won't have the benefit of base effects, if you remember 2022 to 2023 coming out of a lockdown. Then the base effects, the effects compared to 12 months ago, essentially that's what base effects are, of course. They were easy to beat, whereas now slightly or much harder to achieve. Super Tuesday, that came yesterday in the US. Results really point to a rematch between President Biden and Donald Trump. Interesting. Forex market's pretty subdued now at the moment. Action only really in the non-traditional FX pairs. And that kind of reflects gold and Bitcoin, which have been grabbing all the headlines, of course, and touching record highs. Bitcoin set a record high above 69,000 before quite a sharp retreat, probably profit taking ahead of that sort of 70,000 level, really. Gold, let's just touch upon that now. And let's grab a chart first of all, which I'll just show you here, if you bear with me 1 second. There's the gold charts. Yeah, gold obviously grabbing lots of headlines. Momentum really quite interesting from Friday's breakout. Fresh record highs. And really, although the rush from momentum traders to rebuild longs has slowed, we do wonder whether any dovish hints from Powell today could mean further gains maybe on the radar. We'll look at it technically shortly. Interesting Super Tuesday, obviously confirming Trump's Republican nomination could possibly support gold further out as geopolitics become a big focus. Just watch for sort of China bashing, if you like, as we get through the build up towards November. That could become a big factor for markets, for gold, for interest rates potentially, but for gold, it being, of course, a safe haven asset. Central bank buying as well will be expected to ramp up further. I think the Gold Council said they expect central banks to ramp up buying by 24% this year. So expect that to be a sort of longer term underlying theme and underlying support for the precious metal. As I say, we hit $2,141 record high, so surpassing the record high close, I should say. The close was at 21.28, beating the previous record on Monday, and then of course on Friday as well. That all came about because of a slightly softer dollar, slightly softer treasury yields rolling over, and then of course this strong technical buying reaction that came after weaker ISM figures both on Tuesday and yesterday, really slightly increasing rate cut expectations. I think it's really interesting that obviously we dropped below 2,000 in mid-Feb. And certainly the factors that we saw last month really with lower rate cut expectations, stronger dollar, stronger yields. We continue to see selling from investors in ETFs, but we sort of did hold around that 2,000 level. And with all those negative factors, you kind of thought, yeah, this is pretty positive for gold in the longer term. I think we did point out a couple of weeks ago, after we stabilized and sort of tracked sideways, consolidation around that sort of 2025 level. The 50-day moving average, that's that blue line, that's at 2038 now, but we tracked around that. And the bullish momentum really saw us take off, of course, on Thursday and then Friday, especially last week. I think probably going forward, we've still got strong physical demand from China, from India. The economic outlook, especially in India, means there is potentially strong physical demand through the year as Indian consumers get used to higher prices potentially, but the economic outlook is positive, as I say. You also got then low short selling appetite at a time of still sort of relatively heightened geopolitical tensions, and as I say, those may increase as we get closer to that November US election as well. Bottom line as well, certainly, or underlying all of this will be the Fed's stance, of course, and probably if they're still stuck in wait and see mode, that could keep the rally in check, as really then a higher for longer narrative could see dollar support and gold prices just hold off moving higher. You can see technically on the daily chart, we're well overbought, in overbought territory on the RSI. And we've got Keltner channels in here, which we like to use, similar to Bollinger Bands of sorts, if you use those. But you can see we're way out of the upper band of that. And you can see previously that spike high back in December, because obviously different candle setup and price action. But yeah, we did poke out of that upper band there as well. Doesn't mean we can't trade along the upper band, as you can see here back in October last year. But at some point, once you use a different or a combination, which is what we like to do, of different indicators, then we are due a correction. The all-time high, intraday high, you can see there at 21.48 for your guide. Okay, otherwise, yeah, if we move on to equities, tech, of course, has been in focus. That ended down more than 2% yesterday, despite a late hour rally. Also, consumer discretionary was low, as Tesla has taken, well, a two-day beating really of more than 10% in 2 days. Tesla's now down. I quite like the look of this chart, actually, which I just want to show you. Just bear with me 1 second while I grab Tesla's chart. You can see, yes, we're just now very close to very long-term support. If I just pull the chart back, you can see this 61.8 that I've put in here, which is a fib level of this move from the 2023 low up to this high in July. So the 61.8 fib level is at 177.25. We're at 180.74, and then if you see that low from well, this year's low earlier on in February is at 175.01. So around this area, strong levels of support, and it'll be interesting really to see how price action develops on or for Tesla. Aside from that, of course, yeah, sorry, just on stocks, just checking out where we are. Yeah, yesterday's sort of price action, not really a macro story actually, but much more a reflection certainly of heavy positioning towards obviously AI, tech, and then the growth space. And that's why we've seen selling in the last few days for sure. Dow only down 1% or so, S&P down. S&P was down, yeah, just over 1%, and then the Nasdaq down 1.8%. That's the Nasdaq 100. As for this bubble, I sort of said I'd mention this. Increasing amount of commentators really over the last week or so, especially been talking about stocks being in a bubble. Ray Dalio, infamous investor, of course, and others talking about this, I think, in the Wall Street Journal. While The Economist, if any of you guys read that, that recently asked a question on its front cover: how high can markets go? Often been seen as a contrarian indicator, but obviously we're all talking about it, I guess. And really, it's just whether this rally, very strong rally, turns into a more frenzied bubble or not. That's usually driven by the promise of a revolution of some type, with overvaluation and the disregard of fundamentals. If we look at, say, the bubble of 1999, 2000, that was certainly one of those. Something but due another, of course, that's a quarter of a century on. And if you just think around some of the ideas of this, new metrics, they can be invented. And it's interesting, we've had, or I've heard of a metric called price to innovation that has appeared as a possible alternative, being cited to the long-standing price to earnings ratio, which is possibly seen as outdated. So possibly that's quite an interesting signal. Investors also start to ignore bad news as mania starts to grow, and we've seen that in some earnings where they've been ignored really. FOMO as well, fear of missing out, has reappeared in financial news, and I think indeed the acronym was said to be trumping the FOMC in importance in a recent investment banknote. Yeah, so some are drawing parallels slightly to sort of now, and as I say, that dot-com bubble of 99 and 2000, Nvidia being compared to Cisco, possibly. Cisco plunged really from 78 bucks at the time, its all-time high, down to 11 bucks in 17 months. But kind of not as many parallels as you might think. We're not close to that euphoria just yet. There's not really massive, heavy retail involvement in equities, nor major central bank money printing really, even though prices do continue to rise or have done when news has been negative. And other risky assets, of course, are starting to surge, like Bitcoin. Other reasons for that potentially, of course, with the ETFs and also the halving of Bitcoin coming up. Regarding valuations, the S&P, well, that currently trades actually, just to look at that on a PE multiple, price earnings multiple anyway, around 20. That level was last seen 2 years ago in February 2022, and pretty much above, the historic average of around 15.7. Certainly, though, that valuation is skewed by the overweight of the biggest stocks. The Magnificent Seven, if we just go back to that for a second, has obviously a weighting around 20, was up to sort of 29% or so. That's probably backed off slightly, and their average earnings multiple was around 34 times. So that was obviously then skewed the S&P valuation higher. But nonetheless, we're not, let's note, the 1999 bubble where earnings were around 28 times. So not nowhere near that at the moment, but just for your guide, thought it's worth pointing out. Okay, if we just look at the indices in general, obviously close to record highs on most of them, and just see some pullback points, I guess. This is the S&P 500. Hopefully you can see this. Yeah, you can see the all-time high from Monday, intraday high that was at 51.49. We now closed at 50.78. You've got this middle part of the Keltner channel around the 21-day moving average. That's a 50.35 possibly, and you can see that's where that previous swing high from mid-Feb was at 50.48. So potentially support around there if we do move lower, but that is just below yesterday's low, which was at 50.56. Below that, then we've got sort of levels, 5,000 level, of course, which is key psychological level to look at on the S&P 500. NASDAQ, that's come off, as we say, more sharply than the broader index as tech takes a tanking, if you like. Yeah, we're back to sort of near the 21-day moving average. That's at 17,832. Below there, then we've got this 50-day moving average around 17,345. That's a lower band of the Keltner channel. So yeah, levels on the NASDAQ 100. The Dow, yeah, we came off those highs at 39,245 some time ago. Did look like it was bullish consolidation, but then we've obviously had this sell-off down below the sort of 21-day moving average pretty much. So potentially support around the 50-day moving average. That's at 38,190 with a swing low there from mid-February, that mid-February low at 38,039. Okay, moving on. Yeah, let's just move on to last week's main events, which were some inflation data. First of all, this is dollar yen for your guide. And I'll just take the counter channels out so you can just see probably better what's been happening. Just touching on Japanese inflation, core inflation, that rose 2% in January. So below the prior 2.3, but above consensus 1.9. That marked the 22nd straight month in which inflation matched or exceeded the Bank of Japan's target. Core, that excludes fresh food, stripping away, well, fresh food and energy, that rose 3.5% in January. So again, lower than the prior 3.7, but above consensus. Consensus was for 3.3% print. So the release really supports the case for the Bank of Japan to end its negative interest rate policy. For us, probably the next key release to look for is the first tally of the spring wage negotiations, set to be released on the 15th of March. That will likely prove or give us pivotal clues about whether Japan will experience another year with significant broad-based wage increases. I think the feeling I've read recently that local institutions think potentially wage negotiations could touch 4%, which is strong. And ultimately, well, consensus, well, probably remains that the BOJ will exit its yield curve control policy and end NIRP. So NIRP is obviously negative interest rate policy at the April meeting. I think a hike is priced in around 80% or so, a touch higher now. So yes, quite strong expectations now. They flattered to deceive really in the past and disappointed in the past, the Bank of Japan in the last few meetings, but potentially this big build up now to a tweak or even a hike in its interest rate policy. We've had mixed comments from the BOJ officials recently. One who raised hopes really of policy normalization soon, but then were dashed sort of 24 hours later by Governor Ueda the following day. As for dollar yen, well, you can see the yen strengthened, so dollar yen came off after the release of the inflation data. That was, last week. Sorry, just checking when that was. The release saw the yen rise, so dollar yen come off, but it was rather modest considering the heavy short positioning. Remember that heavy short positioning and the magnitude of the sell-off, of course, since the start of the year. Kind of raises chances if we do move higher, then obviously I've got this big level in here on dollar yen, which is 151.94, which is the previous intervention level. Key, probably you can see there is strong near-term resistance around that previous mid-February high at 150.88. You can see tracked just below there on numerous occasions, couldn't break it, and then was potentially rolling over. Although certainly that low from last week, 149.20, will be potentially initial support, which tallies with this breakout from mid-February. Below here, if we do lose that, then you've got the 50-day moving average, that blue line at 147.96, and then the first fib level really of this sell-off, which is at 147.45. That's the major fib level of 38.2. Okay, otherwise we did have US inflation as well. Sorry, I was just checking. Actually, you can see this chart now. Apologies if I pause that, which you should be able to see. Yeah, dollar yen chart, 150.88 near-term resistance, then 151.94 is that previous intervention level. Near-term support at 149.20, and then below that, sort of the 50-day moving average and that fib level around 147.45. Okay, just bear with me 1 second. I'll just get to just a couple of graphics that we like to use. We've got and charts actually. So first of all, let's go to US PCE data that was out last week for the Fed's favored inflation gauge, basically a wider basket of prices rather than just the consumer CPI basket. Kind of lack of a hawkish surprise really in this data. Came in line with expectations. Core accelerated 0.4 from 0.2, so that was expected. The headline that rose 0.3 from 0.2, and then core year on year eased to 2.8 from 2.9, while the headline year on year eased to 2.4 actually from 2.6. So generally inflation has been showing signs of cooling on an annual basis, but it's the month-on-month elements which have been showing signs of a pickup. Fed officials actually, interestingly, sort of warranted caution really on just a monthly print, and they're encouraged, of course, by the disinflation trend, and you can see that nicely in this chart, which shows, well, the CPI basket and then the PCE basket as well. The PCE, which are the blue lines running slightly quicker towards the Fed's 2% target, and that is certainly encouraging them, yes, going forward. Also, we had Eurozone inflation, disinflation. Well, that continued in February, even though the headline print came in higher than expected at 2.6 versus 2.5 expected, although against the prior 2.8. Core, which is the key number for the ECB policymakers, because it strips out volatile food and energy costs, that eased to 3.1 from 3.3, but did come above expectations of 2.9. Potentially, well, what does it mean for the ECB? We'll get to the ECB very soon. Yeah, let's get to that very soon. First of all, we will take, well, I'll just show you the chart of this disinflation trend. So falling inflation, that means, of course, and you can see, yeah, just coming lower, although slightly sticky, and for sure, the core number, which is that grey number, still sticky, still, yeah, above 3%. Versus obviously the ECB's target of 2% or so. Okay, first of all, for this week, we'll look at Bank of Canada, that announcement due in a couple of hours. Consensus expects the Bank of Canada to hold rates at 5%. The first rate cut is seen in around June. Inflation, well, that fell back within the Bank of Canada's 1 to 3% target rate at 2.9%. But probably not likely to return to its 2% target until next year. It's a non forecast meeting, so we just get a statement. All in all, policymakers probably not yet convinced that high inflation has been resolved just yet. Particularly, they're concerned about a pickup in the housing market, and as well, shelter costs still remain elevated. Then also, we have had recently the Canadian dollar started to weaken as well. Probably means the risk that the first rate cut will come later than possibly June, as the Bank of Canada will keep policy too tight, possibly for too long, to make sure inflation is headed back towards their target. I think a Reuters poll said that 70% of economists surveyed are looking for around 100 basis points of cuts or less this year. That maps the Fed closely, and I think pricing as well is around 90 basis points for the Bank of Canada for rate cuts this year. Yeah, here's a chart just of that falling inflation, but then we have had other measures, sort of mixed economic data really since the previous last meeting. If we just go to then dollar CAD, which I'll just show you here. Yeah, which hopefully you can see. Yeah, so dollar CAD, obviously, if this is rising, then the CAD is weakening, and we mentioned that already. Yeah, interesting. We've probably got some resistance, near-term resistance around 136 you can see there, but it looks as though potentially we're going to have another go at that. That would happen if the Bank of Canada are slightly more dovish than expected potentially, then dollar CAD would go higher. So 136 is near-term resistance, then we've got a fib level at 136.23. Otherwise, we probably have to go up to sort of 137 and these swing highs from September last year, which were just below 137 and 136.94. That is, if we do break initial resistance at 136. Otherwise, roll over, then we've got the halfway point of this Q4 sell-off. That's at 135.38, possible marker. And then you've got the sort of 200-day moving average. If we get back down into this sort of noise, that 200-day moving average is the black line at 134.79. Okay, also we have today, let's just quickly touch upon the UK budget. So yes, that will be released very soon, actually, I think in about an hour. UK Chancellor, the Finance Minister, kind of made it clear previously he wants to cut taxes for workers, pretty much in a last-ditch attempt to win back voters before a general election. That is on course to be a disaster, really, for the ruling party. I think the latest Maury poll, that showed the Conservative Party having its lowest vote. I think it was 20%, lowest vote ever, or in Maury history, at least, in that polling history, at least. So, yes. I think we should note as well, potentially, if they do push off the election to as late as possible, so very late in the year, at the end of this year, interesting sort of clashing with the US election. But aside from that, they will potentially look to the last point before calling that election. Then potentially we do get an autumn budget as well. So that I think may have sort of been in their thinking, as to then only offering some very small sweeteners at this stage before then possibly a bigger sort of tax cut in the autumn budget. That is, if we do get one, of course. Finances generally, they're tight, and I think latest reports now suggest Chancellor Hunt will pretty much scale back his planned cuts, and the package of support will be less substantial than back in November. I think it's a cut in the national insurance tax of 2p, which is basically on the cards. That's been leaked to the press, kind of incentivizing workers rather than probably the politically more popular income tax cut. The alternative really is to bake in even tighter spending plans for future years to try and eke out then further room for tax cuts later on, but that does look highly challenging at the moment. For markets, really, don't pay too much attention generally to UK budgets, but meaningful cuts to income tax or national insurance could be good news for the pound. It would be bad news for bonds and gilts, but good news for the pound because potentially it fuels spending, but that fuels inflation, which is obviously bad news for gilts, and then possibly adds pressure on the Bank of England to keep rates higher for longer. If that isn't the case, and we don't get too much fiscal stimulus, then possibly it's a drag on the pound as well. You can see cable here. We have kept in this sort of range of sort of 126 to 128.28. We did obviously move down lower towards 125. That low was at where 125.18, but that fib level you can see at 125.25 held as support. We've also got the 200-day moving average, that black line, that's at 125.78, so watch out for that. We're just moving back then above 127, then 128 is a level with 128.28, that sort of high from back in late December. Okay, that's cable. Let's move on to now the ECB. I just want to bring up a graphic first of all with all the main numbers. Hopefully you can see that, and they are, well, these, you like these graphics, we do for sure, because they just provide a real succinct summary of well, what to look out for in ECB, really. Expectations are that they stand pat once again. The previous meeting, well, that saw the Governing Council in wait and see mode, really. That's probably the watchword for most policymakers at the moment. Tracking inflation, of course, which is hopefully going to return towards the 2% mandate. Since that meeting, then HICP, so inflation that we talked about, of course, pulled back to 2.6%. Core metric fell to 3.1, as we've mentioned. Growth perspective, well, GDP, that printed at flat 0% versus negative 0.1 contraction seen in the prior month, while the more timely PMI data actually saw PMI services rise to, well, 50 on the nose, 50.0 from 48.4, so that was encouraging. Although manufacturing did slip again to 46.1 from 46.6, but all in all, the composite actually rose slightly to 48.9, previously 47.9. So still below that sort of 50 contraction expansion line, and still really stuck in stagnation. That's the Eurozone economy as a whole. I have put in here the unemployment rate that did hit an historic low at 6.4%, which really adds to these ongoing wage pressures that the ECB are concerned about. As for comments by officials, they continue to point towards no imminent intention to lower rates. President Lagarde really observing that the ECB is not there yet. She's used that on numerous occasions when it comes to inflation. While most officials, and this is probably key, see the outcome of the April wage data as key for, well, wages going forward, services inflation, and then obviously wider HICP. That wage data isn't released until after the April meeting. So potentially, as I say, wait and see mode by Lagarde, wait and see mode by the Governing Council, and then potentially a cut after that April meeting, which is then in June. That's what markets think, really, pretty much. Very high chance of that happening in money markets. That's what they're predicting. And then a total of around, I've put 90 basis points. I think it's a touch lower, 88 basis points or so total of policy loosening for this year. We do get, I should say, fresh staff macro projections with growth and inflation seen moving lower, although they're probably not major revisions predicted, but just a touch lower on those two. And interesting, potentially the first time we get 2025 predictions for inflation moving towards the 2% or at the 2% target. Anything below that, then certainly that could be impactful for the euro. Okay. Oh, sorry, bear with me 1 second. So let's look at euro dollar just for a second. If I just pull up that chart, which is here, which you can see. Yeah, euro dollar. So yeah, widely, or just looking at the price action generally for the start of this year, obviously we peaked out at 111.39 in late December. Bearish channel, really downward channel. You can see there, I've drawn it in there, series of lower lows, lower highs, quite nice, until we got to sort of just around 107, the 61.8, and also that swing low from December around 107, just above. So that held support. We then pushed up through that top band of that descending channel, then tracked around the 200-day moving average. That's at now 108.30, and then bulls are hoping to push above now the 50-day moving average. So that's at 108.59, with the next fib level at 108.75. You can see that swing high there from late February is at 108.88. So that's probably initial sort of resistance before then we get up towards potentially 109, and then probably a swing high there to look out for 109.32. Otherwise, the 200-day moving average, as I say, that's at 108.30, with then much stronger support around around 108 or so, 107.93. That's the halfway point of the Q4 rally. Okay, that's ECB. Let's finally move on to non-farm payrolls, of course. Let me again pull up a graphic for you guys, which is here. Yes, expectations for, well, a pullback slightly from that amazing report last time. 190,000 non-farm payrolls jobs added in February expected. That is, of course, in contrast to that 353,000 print reported in January. Plus, of course, we had those upward revisions to November and December. So it'll be interesting to watch for revisions, which is always key, we think. Economists, well, they said that the February data is likely to be supported by the unseasonably milder weather conditions in the month. Unemployment, that probably stays unchanged at 3.7. Fed projections from December anyway see that rising to 4.1 in, well, through the course of this year. Then, interesting, the acceleration in employment growth in December and January really didn't mark a genuine resurgence in labour demand, noting that most other surveys, so regional Fed surveys, PMI data, do signal cooling conditions in the months ahead. Otherwise, average hourly earnings, that's expected to rise by 0.3%, so much lower than the 0.6% seen in January, and then the annual rate is expected to fall back to around sort of 4.3% from 4.5% prior. January's jump actually in wages was weather related, and interesting that if we look at the past 3 weather disruptions, average hourly earnings increased by an average of 0.44% in the weather hit month, and then only 0.13% in the following month. So yes, that's NFP, non-farm payrolls on Friday. We now, interestingly, have around a 70% chance of a June rate cut. That would be the first one. As I've said here, bets have been slashed, of course, from over 150 basis points of cuts to now around 85. But that chance of a rate cut in June has moved up higher this week on the back of those weaker ISM prints, sort of around 65. Just below 65% at the start of the week, and now just increasing to around 70% or so. I always say that the Fed looks for sort of that marker of 70% being key for them, so they don't want to upset markets if we're above that marker of the chances of, or the price is in Fed funds futures being higher than 70%. They don't really like to upset that, whereas if we're below that, then there's more chance of them not doing such. Also, should mention just before NFP, of course, we get Fed Chair Powell speaking today. As I mentioned, testimony, semi-annual testimony in front of Congress, both today and tomorrow. Potentially, well, it's I did see normally at 3 p.m. UK time, but has been released earlier, and I think the last time was an hour and a half earlier, actually at 1:30 p.m. UK time, that is. So just watch out for that. Investors, well, we usually focus on the Q&A session with lawmakers where Powell is grilled really on the economic outlook. At the moment, he's probably unlikely to change his recent narrative about needing more data, more confidence, so that inflation is definitely on its way back to the 2% target. Markets will be looking to see whether possibly Powell validates the expectation of 3 rate cuts as shown in the December dot plot. But of course, remember, we do get a new dot plot, which will be released in a few weeks' time. In general, though, as I say, probably most expecting a cautious wait-and-see stance, and anything different to that will spark volatility. There is no doubt. Let's finally wrap up then with a look at the dollar index, the chart, the DXY, which is here. Just remember the dollar index, so that's a basket of 6 of its major trading partners, the index, and by far the biggest weighting is the euro, around 56-57% or so in the index. So by far the biggest weighting, and really it's a mirror image, if you like, of euro dollar in many ways. Anyway, we peaked out in mid-Feb at 104.97, just below 105, and now we're tracking just below that black line there, which is 200-day moving average at 103.73. So probably this level here, the February, late February low, sorry, is at 103.43. If we do move lower, then you've got the 50-day moving average at 103.39 as well. Yes, as support, and then probably the swing high at 104.29 is to look out for if probably Powell is more hawkish than expected, and then non-farms we get another blowout number or not, but that would move the dollar obviously higher if we do get that blowout number. Okay, that is what, 45 minutes or so, probably a bit longer than I would like, but hopefully that's proved of use to you guys. In fact, I'll just show you one more chart which just shows you just this reining in of rate cuts that we've seen over the last few months. The black line was where we were expecting a load more rate cuts than now. The blue line, which is has changed certainly actually, but again just shows you that reining in of rate cuts that we have seen over the previous few weeks, and possibly now is slowing up. I think we did get down to around 78 basis points of rate cuts for this year for the Fed. Remember that the December dot plot, as I just said, that predicted, or the medium dot plot really was for 3 rate cuts of 75 basis points. That was sort of a level that everybody's been looking at, and now we're just sort of moving back towards pricing in a few more rate cuts now as the data slightly turns. Okay, I will wrap it up there. Hopefully that's proved of use to you guys. It's really great having you all on the call, and especially staying for this amount of time. We do appreciate it. No questions I see, so do stay safe out there. A lot happening in the next few days and weeks, of course, with the Fed meeting as well, Bank of England meeting. Happening on the same day as the Fed, actually, sorry, UK CPI actually on the 20th, the Fed is on the 20th, Bank of England on the 21st of March, and then next week we do get the US CPI data, which will be key, of course, for the Fed. Okay, we'll speak to you in a couple of weeks. Take care out there, and we'll speak to you in a couple of weeks, as I say. Okay.